Hello, everyone, and welcome to Indie Real Estate Insights, the podcast where we explore the strategies, metrics, and trends shaping Indianapolis's dynamic real estate market. I'm your host, Rachel Thornton, a website user experience consultant, and today I'm diving deep into a crucial topic for commercial real estate investors, the equity multiple. We'll be breaking down this metric with insights from an amazing blog by Cara Conde, the best Indianapolis commercial real estate agent, which you can find at caraconde.com. If you're looking to maximize your returns in Indy's thriving market, this episode is for you. So let's get started. What is equity multiple? First things first, what is the equity multiple? In commercial real estate, it's a metric that shows the total return on your equity investment over the life of a project. It's the ratio of all the cash you get back, like rental income and sale proceeds, to the initial equity you invested. The formula is simple. Equity multiple equals total cash distributions divided by initial equity investment. For example, if you invest $200,000 in an Indianapolis office building and over 7 years, you receive $500,000 back from income and the sale, your equity multiple is 2.5x. That means you've earned 2.5 times your initial investment, including your original capital. Why is this important? The equity multiple gives you a clear view of your investment's overall profitability. It's great for long-term projects, but it doesn't factor in the time value of money, so we'll need to look at other metrics too. Equity multiple versus other metrics. Let's compare equity multiple to two other key metrics, IRR and cash-on-cash return. This is where it gets really insightful. The internal rate of return, or IRR, measures your annualized return, accounting for the time value of money. So, while an equity multiple of 2.0x shows your total return, IRR tells you how efficiently you earned it, say 12% annually. A 2.0x multiple over 5 years is better than the same multiple over 10 years, and IRR highlights that difference. Then there's cash-on-cash return, which focuses on annual cash flow. If you invest $100,000 and get $10,000 in rental income each year, that's a 10% cash-on-cash return. It's perfect for tracking ongoing income, but unlike equity multiple, it doesn't capture the full picture, including the sale proceeds. The blog emphasizes using these metrics together. Equity multiple shows the total return, IRR focuses on efficiency over time, and cash-on-cash return tracks annual income. Together, they give you a complete view of your investment. How to use equity multiple in your investing. So, how can you use equity multiple in your commercial real estate investing, especially in Indianapolis? Let's explore some practical tips from Cara Conde's blog. First, it's a great way to evaluate deals. Imagine you're looking at two properties, a retail strip mall in Carmel with a projected 2.2x equity multiple over 5 years, versus an industrial property in Kokomo with a 1.8x multiple over the same period. That 2.2x multiple suggests a better return on your investment, making it easier to compare opportunities. Next, setting targets. Stable properties like Class A office buildings typically aim for a 1.8x to 2.5x multiple. Riskier value-add projects, like redeveloping a retail center, might target 2.5x to 3.0x or higher. In Indianapolis, where industrial properties are in high demand due to e-commerce, you might aim for a higher multiple if you're taking on more risk. Cara Conde shares a great example in her blog. A client invested $300,000 in an Indy warehouse and over 5 years received $660,000 back. A 2.2x equity multiple. Cara's negotiation skills helped secure that property below market value, which boosted the return. That's the kind of expertise you want on your side. Maximizing your equity multiple in Indianapolis. Let's talk about maximizing your equity multiple in Indianapolis, where the commercial real estate market is booming. Cara Conde's blog offers some fantastic strategies. One key tip is to focus on high-growth areas. In Indy, that might mean downtown for office properties, near I-465 for industrial warehouses, or retail hubs like Carmel and Fishers. These locations often deliver stronger cash flows and higher sale proceeds, which can increase your equity multiple. Another strategy is negotiating favorable terms. Buying a property below market value or securing better lease agreements can make a huge difference. As a certified negotiation expert, Cara excels at this for her clients. Finally, consider value-add opportunities. Properties like underperforming retail centers or outdated warehouses can be renovated to boost rental income and sale value. Cara's knack for spotting these deals in Indy's suburbs is a game changer for investors. Common pitfalls to avoid. Before we wrap up, let's cover some common pitfalls when using equity multiple and how to avoid them straight from Cara's blog. First, overestimating cash flows. It's tempting to be overly optimistic about rental income or sale prices, but that can lead to unrealistic expectations. Cara uses data-driven forecasts to keep her clients grounded. Second, ignoring the time value of money. Equity multiple doesn't account for time, so a 2.0x multiple over 15 years isn't as good as the same multiple over 5 years. Pairing it with IRR helps you see the full picture. Lastly, misjudging market trends. Indianapolis has a diverse market, but oversupply in certain sectors, like suburban office spaces, can lower returns. Cara's access to the latest market data helps her clients avoid these risks. Wrapping up, that's a wrap on today's deep dive into the equity multiple in commercial real estate, inspired by Cara Conde's insightful blog at caraconde.com. We've explored what it is, how it compares to other metrics, how to use it, and how to maximize it in Indianapolis. Plus, how to avoid common mistakes. If you're ready to invest in Indy's commercial real estate market, I highly recommend connecting with Cara Conde, the best Indianapolis commercial real estate agent. Visit caraconde.com or call 317-999-9888 for expert guidance. What did you think of today's episode? Have you used equity multiple in your investments? Share your thoughts on our website or tag us on social media. I'd love to hear from you. And if you enjoyed this episode, be sure to subscribe to Indy Real Estate Insights for more strategies to succeed in Indianapolis real estate. Thanks for listening, everyone. I'm Rachel Thornton, and I'll see you next time on Indy Real Estate Insights.